So today's webinar is how to create credit score increases, and this is specifically geared towards loan officers. We work primarily with loan officers, but also a lot of real estate agents and business bankers. Before we get into today's topic, I thought I'd share a little bit about who I am, why I'm here in front of you on the screen, and what we do as an organization. So my name is Ivory. I am the owner of Insight Strategies. We are a credit repair and credit education organization. So my background is that's a little outdated. I really should update the time frame, but about 15 years in working within financial services. So primarily in regulatory compliance and default management, a little bit of crossover into lending, some financial planning as well. But the basis of my work history primarily has to do with understanding credit reporting and understanding the default side. And that's what we're really going to jump into today is obviously the credit reporting. What's pertinent to you as loan officers, especially because we're really seeing quite the shift in the type of borrower that is coming to you now with interest rates. And I don't need to tell you what's going on. You see it every day. So this data is from last year, so it's a little bit outdated. We just don't have the updated numbers yet as we haven't finished the year out. So over 69,000 Americans inquire about getting a mortgage, but almost about 25,000 make it to the closing table, as you can see here on the screen. So that translates to about 35% of applicants. And this is income that is taken off the table for you as a loan officer. You put a lot of work, a lot of hours into these people that are either interested, they may not have submitted an application, but they're interested in potentially getting a mortgage. And let me go ahead, I'm going to admit a couple more people in here. And all that work you've already done to try to get the client approved can be saved, and you can prevent more leakage in your pipeline if you have a higher conversion rate by having those tools and having those resources in understanding credit and credit reporting. And beyond that, when you have that strong understanding of credit and credit reporting, you tend to make a stickier client, is what I like to say, because you're able to give advice and provide additional resources that other loan officers just can't. And that makes you more attractive and makes you more likely to get referrals. So now we know that 69,000 people apply and only about 35% make it to the closing table. So what is the reason for the loss of the other 65% of borrowers? So this chart is showing what you can see is it's primarily credit history and debt to income ratio. Those really go hand in hand. If you have a lower credit score, you tend to have a higher debt to income ratio, often because a lot of the products you get tend to be high interest. There tends to be a lot more credit card debt, a lot of predatory loans with high payments and high interest rates. So if you could capture even just a little bit more of this audience and convert them into borrowers that make it to the closing table, it can obviously add a lot to your bottom line when we're talking about what you can do on an annual basis for your business. So today's topic is all about how to create credit score increases. I want to start with the basics. And this algorithm that I have showing on your screen is the FICO score algorithm. This may be new to some of you. This may be a review to others, but we're really going to dive more into the details of how to understand the algorithm and then how to utilize that information to actionable steps that you can take with your client base. So as loan officers, having a strong understanding of the credit score algorithm and how it works can really put you ahead of your competitors. You can be a resource for the borrowers with the answers that may seem simple to you, but are very awe-inspiring to them. Most consumers just don't have an understanding of how credit reporting works. And making yourself stand out against your peers, like I said, is going to get you more referrals. And I'm not suggesting that you need to be an expert on everything credit related, but having that basic understanding and potentially a little bit more of an intermediate understanding can save you a deal, or it can make a deal that didn't seem possible. So let's start by looking at the algorithm. And the algorithm itself on the screen is what derives the number you see, right? That 700, that 640, that perfect 800 FICO, or anything, in between, all the way down from the 350. So ranked from top to bottom here, and I'm going to let me turn on the pointer, the spotlight. Here we go. Ranked from top to bottom here. Payment history. Oh, I turned the wrong one on. Let me clear that. Payment history is going to be the biggest overall factor influencing credit scores. I think that's pretty self-explanatory. Most of us know that if you have a late payment, it's going to damage your score. So anything derogatory can be late payment history, a charged off account, a bankruptcy, foreclosure. I think everybody understands that. But similarly, what most people don't consider or don't think about is the absence of payment history. So not having a lot of active accounts or open history on the credit report can also be detrimental. The absence of information can negatively influence a score, and we'll see some examples of that in a little bit. Now, the second biggest factor is capacity and amount owed. It really just means utilization. So this is the balance versus the credit limits. Now, where most people gain some or get some confusion in this section is regarding loans or any sort of an installment debt. This category is most heavily focused on revolving debt. So when looking at a credit report, focus primarily on revolving debt. You have a lot of clients who will focus pretty heavily on paying off auto loans or other sorts of installment debt, when they really should be more heavily focused on credit card utilization or any other line of credit utilization. Length of credit is 15% of the score, so the third biggest factor. So this is the average age of the accounts in the credit report. If you've ever seen a score drop pretty dramatically after the closure of the account, it's because now all of a sudden the length of the open accounts has been adjusted. Once that account closes, it's now not considered as far as the average age of the open accounts on the report, right? So if you close an account that was open for 15 years and the average age of the accounts on the credit report previously or the other average, excuse me, let me let one more person in. If the average age of the rest of the accounts on the credit reports are closer to 5 years or 4 years, or a lot of new accounts were just opened, you're going to see a detraction on the credit score because of that. New credit is one of the factors that doesn't influence the score as much, but tends to be a factor that a lot of people focus on. This is inquiries and new accounts opened within approximately the last year. So an important piece to recognize here is that inquiries are just a portion of this 10%. The other portion is open accounts, right? It's if you have a lot of new accounts that were just opened on your credit report, it can pull the score down because the algorithm wants to see how you're going to handle all of this new debt. And it could say, I'm a credit risk because I need to take out a whole bunch of debt in a very short amount of time. And the algorithm is waiting to see, do you have the ability to pay that debt? So as the accounts age beyond that approximate 12 to 1 to 2 year time frame, and you show that ability to be able to pay those debts, you see less of a detraction on the score from that. So inquiries, very minimal, approximately 1 to 5 points on average for an inquiry. And there's a lot more specifics to mortgage inquiries. And since we did have a couple people that have joined a bit late, I do want to remind you that you can ask questions throughout. Just unmute yourself, type in the chat. Either way is perfectly fine. I do want this to be interactive and make sure that what we're talking about is applicable. It's something that you want to know, you want to learn about. And if anything is unclear, just don't be shy. And we'll have the option for open Q&A at the end as well, if you have a question on something that isn't covered. So the final factor influencing credit is the credit mix or the types of credit use. Do you have a blend of installment as well as revolving accounts? So the algorithm is essentially saying, we want to see that you have the ability to pay any type of debt responsibly. whether that's going to be a credit card or a loan. So if they are missing a loan and they only have credit card history, for example, there will be a small detraction in the credit score because of that. But again, only worth 10%. So where we are going to spend a lot of the time focusing on today is going to be the top 3 categories, which have the biggest influence on the scores. So when you are looking at a credit report, and we'll look at a couple examples here in a bit, what we also want to focus on when looking at the factors is what's working well for the client's report and how we can optimize it even more. For example, if the client has credit cards that have been open for a very long time and they have excellent payment history with no delinquencies, we know we're positively influencing the payment history category at 35%, and then also the length of credit at 15%. But let's say in this scenario, their utilization is not at an optimal level. Having that borrower pay that balance down to between a ratio of 1 to 9% utilization is going to put their utilization ratio for not only each individual revolving account at the optimal level, but the entire credit report at the optimal level. So utilization is factored in the score at an individual card level, but also at an overall level for all revolving debt on the credit report. So you would see an increase in credit score from that, and it would be fairly substantial because it is worth 30%. So when you're doing a simulator, you're running those scenarios that you have the options to run. What you are seeing is that specific category. Is anyone else hearing choppy audio? It looks like we had one person saying the audio is choppy. If anyone else is having a hard time hearing, let me know.
Good for me.
Okay. I think it might be your side, Edward. Okay. Feel free to exit and then rejoin. I'll let you right back in the room. So you can hopefully hear a little bit better when you come back. Okay, so I forgot where I left off, but essentially, if you are able to positively influence that optimal range of credit utilization, you're going to see a big lift in the credit score. You don't necessarily want to tell people to pay the accounts off to 0% because the algorithm looks for some sort of use in the credit cards to show that you have the ability to use the cards, but use them responsibly. So when you're using the simulator and getting those scenarios where it's telling you to pay off X amount of each card, that's really what it's looking at, is this utilization ratio as the second factor that influences the score. So your simulator is limited on what it can do. It can't do as much as our minds can in interpreting the options available for improving scores. And that's why today is going to be so important. So along with looking at what's working well and making it work better, you also want to look at what's missing from the report. And this is something that your simulator just won't do. So we see credit mix and types of credit used, and then utilization ratio combined influencing about 40% of the score, right? So we've got this 30% here, and then types of credit used at the bottom at 10%. So if a borrower has no open credit cards, they're missing the positive impact from both of these score factors. So by advising the client to open a credit card, you'll see a lift in the credit score. And depending on their report, it can be extremely substantial to moderately substantial. Someone with a very limited credit history, you're going to see a massive jump in scores from a scenario like that. Any questions on these 5 factors? I did do more of a high level overview. So if you have any specific questions, we can definitely dive into some of the details on that as well. Okay, I'm going to take that as a no, and then I will go ahead and move on to the next slide here. Okay, so let's break down the credit report, and then we're going to start looking into some examples. So when you pull a credit report, the obvious is true. We know it has the personal information, names, dates of birth, current address, previous address, employer, etc. The important piece that you really want to focus on is the score factors. We have the next section being the account information in the trade lines, which is something you'll want to focus on as well. But in the beginning, when you're really getting used to trying to identify the potential score increases, score factors is gold. So what are the score factors? These are what they look like on the credit report. So you may have, this is from one lender credit report. So you're going to have your own providers that you're pulling from, but nonetheless, there's going to be a section that says score factors. And it's going to look something like this. So here we have our reason codes and then the description. So these reason codes and then their descriptions are in order from the most impactful to the credit score to the least impactful. What I mean by that is what is pulling the score from being a perfect credit score. So the most impactful item that's detracting from the credit score, bringing the score down in this scenario, specifically for Equifax, is the time since the most recent account opening being too short. Second biggest factor is too many inquiries within the last 12 months. Third is the length of time the accounts have been established, and then so on, right? And that's going to be different for each bureau just based on what information is reporting on each bureau. So that being said, I want to point out that this credit score or each of these scores are extremely high, right? We've got a 795, 777, and a 784. So when you're seeing scores that are close to perfect, small things worth 10%, because as a reminder, inquiries are worth just a portion of the 10% of the score. They're going to be higher up in the ranking, right? Because there's not a lot that's pulling this credit score from being perfect. But unless the score is perfect, there's going to be something listed in these categories. So any questions about where to find score factors or what they are? Okay. I'm going to move on. So let's look at a scenario. I'm going to start off with an easy one. So we have solid credit scores here, but this client in this scenario wanted to qualify at a 740. They wanted a higher credit score, right? They wanted a 740 when going in to apply for the mortgage. So this is a screenshot of what I see on my credit report side. It's going to look a little bit different than what you have on the lender side because I have all these different versions of FICO that I can look at. But in this scenario, what do you think could be done to influence the credit score? So top reasons detracting: number 1, no credit card activity; number 2, no revolving activity; number 3, too few credit cards. What do you think? I think it's fairly obvious, but if someone wants to shout out the answer or type it, I'm going to ask for a little participation here.
Use your cards.
Use your cards.
Use your cards. So in this case, it's very close. It would be open a credit card or use your cards. So the too few credit, you can't see the report, so obviously you don't know the exact scenario, but this person only had closed credit cards. So the lack of any activity on the credit cards is detracting the score. So you can have an open credit card. They could have 5 open credit cards, for example, but if they haven't used them within 6 months, you're going to see something like this popping up. Now, this person, once they open the card, their scores are just going to skyrocket up. So just not using the card, if there's not 6 months of activity, it becomes a stale data. And then the algorithm is going to request that that person uses the card. You'll see a big score jump. So if you ever see a scenario like this, where towards the top, it's too few credit cards, no revolving activity, no credit card activity, very obvious one for you. Okay, so we started off easy. So again, looking at the actual score factors, there's no positive impact coming from the utilization at 30%, credit mix is not being impacted because this person had no credit cards. So we're missing another 10%, and then missing ongoing active data flow from the payment history, which is 35% of your score. So 75% of the score could be influenced in a positive way by opening a credit card. Okay, another scenario. So in this report, what we can see is length of time accounts has been established is the number one. The second biggest influence is level of delinquency. Third is too many accounts with balances, number of accounts with delinquency, too many inquiries. And we have a similar theme if we look at each bureau. So there's a couple of different things we could do in this scenario. It's not necessarily just one solution. What would you recommend in this scenario? This one's a little bit of a trick question. Remember, we can focus on what's missing, or we can optimize what may be working. I'll give it like 10 seconds and then I'll give you the answer. Okay, so if you ever see length of time accounts has been established, the first thing you want to do is see if they have a family member or a spouse that will add them as an authorized user on a credit card with low utilization and positive payment history. It's basically a strategy to add longevity onto the credit report. It's also going to add positive payment history, and then obviously influence credit mix, especially if this is somebody with not a massive amount of credit history. You're going to see a really, really significant boost on their credit report just from adding the authorized user. So in this case, this was the number one factor influencing the score. It would likely push this person closer to the 700 mark. And then the too many accounts with balances, I think we all know that one. Pay down your credit card balances for what you do have. It's likely that person just had a lot of brand new credit cards with high balances right out the gate, which is going to influence them pretty negatively. So the combination of both adding an authorized user and paying down the balances would definitely put that person over the 700 mark. Now, when you see something like level of delinquency, that's not really something you can, my apologies. That's not something you can really influence on the credit report on your end, unless you're doing credit repair yourself as a loan officer. So that'd be something, you'd have to refer outside. If they want to do their own credit repair, try it themselves, or if you want to go to a third party like us. But you can still get a substantial improvement in score even without addressing that item on the credit report. You don't always have to do credit repair for the client, which might sound weird coming from a credit repair company, but it's not always necessary. Any questions on that scenario?
Yeah. Nope. Great so far.
Okay. So let's look at one more. So in this scenario, we see serious delinquency public record, lack of recent revolving account information, lack of recent bank revolving information, time since delinquency too recent. This is going to be one of those scenarios. These are quite low scores. This is going to be one of those scenarios. Are you trying to get them to qualify at the bottom edge of score qualifications? If so, you may have the ability to get them there. In some situations, we'll see I do not have time. I just need the bare minimums to qualify. I will work on my credit and we can refinance later. This is the type of person where you want to advise them to get a secured credit card because they just don't have open credit. That's going to pull their scores up quite a bit. It may surprise you, but they'll probably get quite close to 600, if not at 600, just from that. Especially if they have a more thin credit file, a lack of a lot of credit history. Maybe they have just a couple collections, just a couple charged off accounts, but that's just kind of overwhelming their credit score because there's just not a ton of history. Just opening that card is going to push them up then you can have them work on their credit through credit repair, whether they're doing it again themselves or hiring somebody outside, and pull their scores up, refinance them later to get them, into the 700s would be ideal, but at least high 6s. And some clients don't want credit repair. So I just want to make sure you have, even if you see a 548, if you read these score factors, there's going to be some clues on what you can advise them to do. And it can sometimes be just this simple. And a lot of times we see this with people that do have lower credit scores. They don't have an open credit card. So it's just that very easy, simple solution, get a secured credit card. So, okay. And we talked a little bit about this already. It's the same as the other one. Credit card is going to influence about 75% of their score. I want to talk about what not to do. And in turn, this is going to help you understand how you can still create more increases. So one, don't assume inquiries are the problem. Inquiries are rarely the problem unless they are in that higher echelon and they're just trying to get a perfect 800. I know you probably hear a lot of fear around your clients wanting you to not pull their credit or doing a soft pull. We do have some videos and some emails, things you can send to clients who may be very, very worried about the inquiries that might help them feel a little bit more secure with it. So if that's something you're needing, shoot me an email after this. You'll have my email information when I send out the recording. Do not instruct a borrower to pay off collection accounts. Now, my caveat to this is medical collections, but first I'm going to talk about a regular collection that's non-medical. So instructing a client to pay off a collection account won't have any impact on their credit score. It unfortunately will only show paid off. And now that's still on the report for the next 7 years, 0 impact to the score. The only way to cause an increase in the credit score from a collection is through the removal of that account. So the collection is going to be considered a severe delinquency. It's impacting that payment history, that 35% of the credit score. So it is a big impact. And of course, the more collections on the report, the bigger the impact. A lot of clients may come to you saying, I'm paying off all my collections so I can improve my score. The first thing to ask them, if they do tell you that, is, did the collection agency agree to delete the account from your credit report? Or did they just say they would update it as paid? Most of the time, they're going to stop and they're going to say, I don't know. I didn't ask. Encourage them to reach back out to the agency and request that they get confirmation in writing that the account's going to be deleted for in exchange for the payment. Now, we don't typically recommend rushing to payment. There is a full validation process, but credit repair just isn't something that everybody wants. Or people don't want to wait for the process. So if they are going to pay it off, just make sure they're getting in writing. It will improve the score significantly when the collection is removed. I'll give you an example. Oftentimes we will have clients that we get from loan officers because they start the process with a credit score well above 740. One example recently is we had a client come to us. His scores were in 780, 790-ish range in all 3 bureaus. So what had happened is a Comcast collection got added to his credit report and it dropped him all the way down to 680 range. Obviously that has a massive impact on the loan process. And in his case, he ended up hiring us for the credit repair. We got it removed within the month and his scores resumed back up. So if he would have just gone and paid it, it's now harder to get it removed, and he's stuck with that on his report for 7 years. So a lot of people will rush to trying to pay it to help themselves, but it isn't going to do that. Let's see, medical collections. So back to medical collections. Now, there was a law change in July of this year. So any medical collection that is paid will automatically be removed from a credit report. So if you pull a report and all you see is a bunch of medical collections and, they think they're all valid, they can call those collection companies, get those paid off. And, within about 30 days, you're going to see that report updated and the scores jump way up. So easy solution. You see medical collections, you can advise them to do that. If they're not sure they're valid, again, they can go through a credit repair process or go through the validation process on their own with that collection agency if they're familiar with that process. Okay. Do not instruct a borrower to pay off an installment account or close a credit card. This is going to drop the scores. Again, I had brought up earlier, the average age of accounts is impacted. The older the account, the worse it is. In scenarios, I understand there are going to be scenarios where debt to income is an issue and you need those debts to be paid off as for them to qualify, right? If that's the case, have that payoff occur as part of closing, because you're preserving the credit score in the credit report, but also maintaining your needs for a better debt to income ratio. Now, again, if you're paying down a credit card or paying off the credit card balance and keeping it open, totally fine. That's going to help the score. So more related to installment accounts, if you need those to be gone, just make sure you do that payoff as part of closing. So you're not seeing a big drop in score because of that average age of accounts being influenced. Now, something to be prepared for, as we are starting to see the wave of cancellation of Biden's cancellation on the student loans, we're going to see a lot of accounts that have been around on people's credit reports for a lot of years closing. If that $10,000 or $20,000, depending on what they get approved for, covers that full loan amount. This means we're likely to see a drop in a lot of people's credit that they aren't going to expect. So if you have a borrower that comes to you and they're so very confused, that may be one of the leading questions to ask is, did you recently get approved and see the payoff of your student loans? That may very well be the answer. So just something to keep in the back of your mind. I haven't seen any of the cancellations actually post on anybody's loans yet, but we're likely to start seeing that soon. And because there's so many student loans out there with tiny little balances, we're probably going to see, a lot of 3,000, 5,000 tiny little accounts closing for those that have their loans spread across a lot of different accounts. So okay, next, we will move on. Okay, if you're not sure what to do, if you have a complicated report or you're just not sure how to read the report, we do have a webinar on how to read a credit report. That was last month's webinar. So that goes a lot more in depth in exactly how to read the credit report. But two, you can always reach out. If you have a partner, reach out to your credit repair partner, or if you don't have one, you can reach out to us. We review all reports for free for loan officer partners. So we will review the report and we'll say exactly what to do. Sometimes it's just not so simple. Or if you're trying to figure it out or get acclimated with reading the reports, feel free to be like, I think this is the answer. Is that quite right? And we'll give you a whole written summary and let you know what to do. A lot of times there's a ton of options for improving the score. Again, looking for things like adding the authorized user. You can add some cushion on the credit report by doing things like adding Experian Boost. There's other things, other reporting mechanisms I like quite a bit better than Experian Boost, but consumers like that it's free and immediate. There are companies you can utilize that will add trade lines for your utility bills, subscription services. There are debit cards that now also report to credit. So for those people who have more thin credit file, that can be a good tool to add or bolster create cushion on the credit report. If there's negative information on the credit report, the more cushion you can add by positive reporting, the better. And a lot of that you can exclude when you're submitting to underwriting because it's, utility bills, right? Okay. If you are in a situation where you have somebody that's credit report looks like this, right now, it's so very hard to get people approved, even at like that 580, the low sixes, even mid sixes, because we've got these prices that are still so darn high and these rates that are a bit higher. I know we had a better day today, but we will review that report with that client if you refer anyone our way. So the way our process works, you refer somebody our way, we have a partnership portal. You can submit their information, including their credit report. We'll have a free consultation with them where we walk them through their credit report, help them understand those score factors, and go line by line, or trade line by trade line, if you will, to understand what had happened with each of those accounts. Give them an idea of what we may be able to get removed from their credit report, what we may not be able to do, and then give them an idea of what their credit reestablishment plan would look like. So we've got the removal side parallel with the reestablishment side, which is the adding of the good information. Anyone you refer, we call within 24 hours. We may not get a hold of them, but we always call them within 24 hours. Or they have the option to book time on our calendar. So once you click submit on that referral in the partnership portal, it emails that client immediately, gives them the link to book on our calendar, and then tells them you sent them. We're going to call them. If they do end up working with us, their client portal on their end, they will see all your contact information, your headshot if you let us use it. That way you stay top of mind. And then throughout the process, we do include you on the emails where we're like, you had an amazing month. Look at that 70-point increase this month. You're so close. Because we want to make sure that you're there to cheer them along, and they do feel like this is a whole team approach. And then they are included we have webinars on the consumer side. So they're included in those monthly webinars if they choose to attend. They're sent the recordings if they don't. And then they're included in 2 different video education options that we have, one on credit cards and one just generally on credit and how credit works. And the goal is to keep them from doing the things that are going to disqualify them. We don't want them, going out, getting new loans, getting that furniture credit card, and, racking up a new balance and changing their debt to income. So we do a lot of advising on how to lower their debt to income going into getting the mortgage though too. So if they do have auto loans that are super high interest, we're going to make sure we tell them when to refinance it. They're going to have to do the letter of explanation. We know that, but it will end up helping their debt to income in the end. So anyway, enough of that rambling. With the removals, we've removed about 13,000 negative items from our clients' reports. 400 to 500 FICOs end up in the mid 700s, usually within about 6 months. Longer end is 8 months, depending on complexity. So if you have those harder situations, you're going to want to think of a credit repair partner as a long-term hedge. We're going to be filling your pipeline for later. These aren't going to be the people you turn around really quick if they are in that lower range. It's going to be different for someone who's just on the cusp, right? Maybe they're at 660 and you want them to be at 680, a lot faster options. But if you do have somebody that's a ways out, we can shorten that instead of you calling them for, the next 2-3 years where they're working on their credit, we'll shorten that for you. We can work with clients pretty much anywhere except for Georgia. So currently we're working in 28 states. We're located in Washington state. We do have employees that are here very early, 6 a.m. So that way we can service that side of the country early, and you're not waiting until halfway through the day if there are questions and client needs. And other than that, I'll just show you a little bit of a couple scenarios for what we can do on the credit repair side. So we had a client, Allison, and I did change everyone's names just for privacy. But we had a client, Allison, that came to us with a 514, 518, and 473. 7 months later, she was at 741, 681, and 714. In her scenario, she had a lot of delinquent student loans that were in default. So we helped her rehabilitate those, got her approved for loan forgiveness as well. So about $20,000 was forgiven for her after she finished her repayment plan. And then we removed every collection on her report. So what was left is just a little bit of credit building. So you can see we had a little bit more credit building opportunity on one of the bureaus. She ended up getting that higher, but she was just already done with us by that point. So I didn't include that. We had another client, Tim, that came to us with a sudden collection popping up on his report. And this is a scenario that happens a lot. In this case, it dropped his scores from 713, 712 and 712, or dropped them to that, excuse me. And then in less than 30 days, we got his scores back up to 764, 765, and 762. So that was one of those sudden collection incidents. We try to get those done in 30 days or less. Sometimes it ends up taking longer, but the goal is 30 days or less. We want to save your deals. And then we had another similar situation with Wendy here. Her score went from 800 and 700. Collection was only on 2 bureaus, down to 630 and 640, and got her back up to 799, 793, and 781. That one did take longer. So that one took 3 months, but again, we try to do everything as quickly as we can. And the last one, this is, I think, my favorite one, just because of her story was very, very heartwarming and sad and everything. She had 39 collections on her credit report. All of her collections were due to her trying to take care of her husband over a couple years while he was slowly passing away. It took us a year. I think it was a year and 1 month. But we were able to remove all 39 collections. And the house she'd been living in for 20 years, the owner was just ready to sell. She'd been renting it for 20 years, and she ended up being able to buy it from that owner, which was just absolutely wonderful. So just a couple of stories of what we can do. It's, if you have a client with low credit, it's not an impossible scenario. Every single one of these clients went back to the loan officer that referred us and finished the deal with them. So basically everybody has hope as long as they want to work on their credit. And as long as you have the tools and resources needed. I want to open it up to see if anybody has any specific scenarios or questions. Oh, I missed something in the chat. I'm sorry. Self Inc. Have I heard of Self Inc? I had a client inquire about it this week. I have. I'm going to take us back to a slide while I talk about Self. I'm sorry for everybody seeing the screen switch so much. Okay. Self is a credit building tool. So what Self is a credit builder account, or a credit builder loan, if you will, with a secured credit card that's attached to it. So a credit builder loan is a loan where you agree to a term ahead of time. So you agree to an amount in a term, let's say $500 that you're going to pay back over 6 months to a year. They have a tool where the client gets to decide that payback schedule. And instead of the money being given to that consumer up front, what you do is you pay monthly. So if you say $500 and it's 12 months, you pay monthly for that 12 months until you hit that $500 amount, and then they give you the money back. So with a little bit of interest. And it's meant to influence payment history by adding positive payment history on the credit report. It's meant to also influence the type of credit used. And then, of course, the longer term they choose, the more it's going to impact length of credit. Now, once that client has had that account for 2 months, on the 3rd month, they also provide them with a secured credit card. That secured credit card then also influences everything that a credit card influences. So instead of them having to put money down to get that credit card, because they're paying monthly for that credit builder account, they use that as the security deposit for the card. And then over time, they increase that credit limit for the consumer. So that, of course, is going to also influence payment history because it's adding an additional trade line. It also influences the types of credit used because now they have revolving and installment. And then now it impacts the utilization ratio, right? As long as they're not carrying a high balance on the card, it's a positive influence. So it's a really great credit building tool. Hopefully that answers your question, but it has a really, really good impact. It is one of the products we often end up recommending because it has such a small impact on debt to income ratio. Most people will choose a payment of $25. So we're thinking very minimal impact to debt to income while still building credit.
Thank you. That was perfect.
Yeah, definitely. What other questions do you have, or scenarios? Anything credit related, we're here to answer. Since everyone's here, don't be shy. No recent credit scenarios. I know you've been seeing some weird things lately. We've got a lot of new borrowers coming in that were kind of sitting on the sidelines before.
What would you say is the optimal percentage to stay under? And I may be putting this incorrectly, but like I always say 30% below, you don't want to use 30% of your high balance.
Yeah.
So
So
is that an accurate number, or is there something that I could be advising better?
Yeah, the actual optimal ratio according to FICO, and FICO is the one that obviously creates the algorithm, not the credit bureaus. So what FICO has determined is that the ratio of 1% between 1 and 9% is considered optimal. So you're going to get a plus factor for being between 1 and 9%. Very, very slight detraction being at 0%, right? Having no balance. Now, I never recommend people carry a balance. The only exception to that is you're getting ready to apply for something. You can have 1%. That's really not going to do much to your debt to income ratio, but it's also going to create a little bit boost to your score. We hear 30%, you hear under 50%, you hear under 75. So there are tiers to where it's detracting from your score. So 100% is obviously the biggest detraction. Actually, overuse of the card or being over limit is the biggest detraction, but then 100% is the biggest after that. After that, there's another break at 90%, another break at 75, another break at 50, another break at 25%, and then we've got the 1 to 9% after that. So there's breaks. It's tiered, I guess is the best way to put it. What other questions? I'll bring another thing up that I did fail to mention. If you do have a borrower that has multiple charged off accounts, having that borrower, pay the balance down to 0. It doesn't matter whether they settle or not. It's already a severe delinquency at that point. Having it updated to zero is going to have a positive influence on the score. So it's very different from a collection where making the payment and getting that updated to 0 has no influence. A charge off will positively influence the score. So if you do see those scenarios, and your borrower is asking for advice on what to do, and they have the funds, right? I mean, that's obviously a very important factor. Paying the charge off will help their score. So that is another way you can see a boost in their credit score when you're getting ready to qualify them. Okay. Well, it sounds like I did an excellent job answering any question that you could have possibly had. But if something else comes up, like I said, I will send an email out with this recording. And then, okay. And then what I will do, I can't see what you're showing me, Brooke.
You did great. I have.
Oh, thank you. And then if you do have a question that pops up, you can reply back to that email. If you end up wanting to partner with us, feel free. You can go to insightstrategies.credit. And then there's a partnership form you can fill out, or you can just email me. I'll throw my email in the chat real quick. And we can always get that set up and we can have a conversation. You don't have to decide right now. If you want to just be on our email list, we send a lot of different videos that are a lot shorter than this webinar on different topics like this. Throw your email in the chat or email me there and I can get you added. But otherwise, I will let you know when we have another webinar, different topics every month. Some are a lot more in depth, some are a little bit more high level. If you have a topic you would like us to have a webinar on, let me know. But pleasure having you all join. Thank you so much.
Thank you.